Do you want to safely earn much higher returns on your reserve funds than you can from a typical savings or money market account? Well, of course you do. Follow reserve investment expert Dave Lynn as he goes over best practices on how to get commercial-sized returns on your investment without costing your association a cent. I certainly learned a lot from Dave. I'm sure you will too.
And with that introduction, that brings us to the meat of our program today, some time with Dave Lynn, who will provide us with his decades of insights about what to do with your precious reserve funds. So Dave, the microphone's all yours.
Thank you, Robert and Paige. The way you stress decades, it just makes me feel old, Robert. So.
Okay, everyone, Dave's years of experience.
Yeah. Thanks, everyone, for joining us today. I really appreciate it. I want to stress that the first and most important aspect of managing reserves for community associations is safety of principal. It's a fundamental aspect of investing is that if you expect a greater than average rate of return, you're taking a greater than average rate of risk. And for community associations, you have a fiduciary responsibility as a board member and a community manager to not take risk with other people's money. So we're working essentially in a zero risk environment. That is, we don't want to have any loss of principal or default on any of the investments. So safety is the number one priority. And you should achieve that level of safety by making sure that everything in then reserve accounts is FDIC insured or backed directly by the U.S. government. So in FDIC insured investments would be CDs that are in the name and tax ID number of the community association, and they're in increments less than the $250,000 FDIC limit. I stress less than, so that not only the principal but the accrued interest is insured. And I also, when we purchase CDs for our clients, we make sure they're purchased from well-capitalized investment grade rated banks. Any money that's not in a CD should be kept liquid in FDIC insured money markets. So whether an association has $50,000 or more than $5 million, everything in the account should be covered by the FDIC, with the exception of buying individual treasury bills and notes. These are treasury obligations directly backed by the U.S. government, the full faith and credit of the government. So an association, again, should only have FDIC insured CDs and money markets and possibly U.S. Treasury bills and notes. After safety, it's your job to make sure that you have money available when it's needed. So if I'm told by a client that they anticipate spending $50,000 between now and the end of the year, we're going to make sure that we have at least that much money liquid in the FDIC insured money markets to cover that capital expenditure. We use a conservative strategy called laddering, where we typically keep about 10% of an association's funds liquid in the FDIC insured money market. And the other 90%, we recommend laddering or staggering the maturities of CDs so that you have a CD maturing a couple of times a year over the next couple of years. For example, an association might have 6 CDs. You buy a 6-month, a 12, 18, 24, 30, and 36-month CD. In addition to having money in the money market. These CDs can be from various banks so that, you're under the FDIC limit. And then every 6 months as a CD matures, depending on what your money market balance is and upcoming anticipated expenses, you can roll over a portion or all of that CD into another CD. Now, generally speaking, in this example of a 3-year ladder, you would have the 6-month CD maturing, you would have it reinvested into a 3-year CD. The advantage of this is that even if rates don't increase over the next 6 months, the overall yield of your portfolio would, because the lower yielding, shorter term CD is maturing and being reinvested into the longer term, higher yielding CD. So that over time, your portfolio would have the yield of a 3-year investment in this example, yet would have much more liquidity because in addition to the money you have liquid in the money market, you have a CD maturing within 6 months at all times.
So you have a lot of choices and a lot of flexibility.
Correct.
Got it. Dave, you talked about liquidity and having funds available and maybe a general rule that you hold 10% in not quite cash, but liquid and readily available. But let's talk about what it looks like for different clients, because I imagine you're talking about custom situations and the decisions you make for one client may be very different than the decisions you make for another client. So let me show you a few case examples here. What I'm going to show are what we call the expense scenario, the expense pattern for an association. So what do you start to think when you see this type of expenses, annual expenses at an association?
Yeah, when we first start working with a client, Robert, and periodically, not only will we look at the reserve study, but we also speak to the board and the community manager to make sure that they're on track with that reserve study. As an example, we talked about this. If you say they're going to spend $500,000 on roofs next year, but the reserve study is 2 or 3 years old, and the board and the managers decided they're going to start a phased replacement over time and not do it all in one lump sum, then that can affect how we would invest the funds. So we're always going to speak to the community manager and board members in addition to looking at the reserve study. And this example for case one, in most reserve studies, I know you do go out, 20, 30 years or more, but I am not recommending investments past 3 years. So we take this whole 30 or 40-year spectrum and crunch it down into 3 years. And what we want to make sure is that if there's any major expenses coming up in the next 3 years, we want to more heavily weight that particular time frame. For instance, if there's a roofing project or a street slurry project due next summer, and that's going to consume 50% of the reserves, then we wouldn't recommend this 6 to 36 month CD ladder, at least not in even increments. We would more heavily weight next spring and summer, having more CDs maturing in time to meet those expenses. In this case, one example, we would still invest, even though there's not a lot of expenses this year or next year. We wouldn't just start with 2 and 3 year CDs. We would start with 6 and 12 month CDs and then build our way out to 18 and 24 months. The reason for that is twofold, essentially, that things can break sooner and cost more money than what is anticipated. And secondly, if rates begin to or continue to increase, you'll have the shorter term CDs maturing in time to take advantage of those new higher rates.
Yeah, I want to make sure everyone listening heard that although we make the projections in the reserve study, there's always a reason for, Mother Nature gets its way, and a roof may fail early, the asphalt may fail early, everything may fail early. And so you want to be careful and make sure you have a little bit of margin for a little bit of extra room. And then, like you say, we're only presenting one element of the picture here, and that's a planned expense scenario. As I hear you, it depends how much total cash they have available, and also depends what the board might be planning around the corner. They may have a landscaping improvement that they're going to try to do with this drought situation that we have, and so maybe they're going to push that up a couple of years. And so that interview, I think, shows that you're looking at multiple things when you're dealing with a client.
Absolutely, yes.
Okay, cool. Well, let's look to the next case. Let's look at case 2, and what kind of thoughts do you have when you look at this expense scenario?
Okay, again, I see in the second or the third year, it looks like, if I'm reading this correctly, the third year looks like there's a bulk of expenses. So again, we can start with 6 and 12 month CDs and 24 months, depending on how much money the association has. For instance, that expense in the third year, it looks like about $550,000. If the association has a reserve fund balance of $1 million, and this isn't really an issue, we can just stick with your standard ladder. We can more heavily weight the second year and third year to get a better rate of return now, knowing that you're not going to have a great deal of need for the funds in the first year and a half based on the reserve study. But again, a lot of this depends not only on our anticipation of what interest rates are going to do, but how much money the association has in the money market. Looking at a chart like this, and if it's $500,000 expense, again, if it's an association with $3 million, it's not as big of an issue, if you will, than if the association only has $500,000 and they got to really make sure that those funds are accurately invested and that the reserve study is accurate so that we have the funds available when needed.
Right. You have the cash ready to write some checks and pay some bills when it's time to get that work done.
Exactly. Yes.
Fantastic. Okay. Tell me what you see when you look at case 3.
Yeah, we come across this sometime when we bring a client on, and if you have a huge expense in the first year, maybe a client comes in and with $500,000 in reserves, I get ready to talk to them about a 2 or 3 year CD ladder, but then I understand they have an upcoming expense due in the next couple of months. is going to take the bulk of their reserve funds. In that case, we would just keep the bulk of the money in the FDIC insured money market. Perhaps if we're able to, we'll put some money into 3-month CDs or roll 3 and 6 month CDs and just wait, have the money available near term, short term, so we can take care of that big expense that's coming up. And then once the dust settles a year or so from now, when that big project is finished, then we can begin building out that ladder a little bit further into 12, 24, 18-month CDs like that.
Yeah, because after this first year, it looks like then you've got maybe 10 years before you've got the next big, not unsettling, but the next big staggering expense to face.
Right.
Excellent.
So yeah, as we talked about that, if you're going to work with an investment advisor, he or she will, or a good one should want to look at your reserve study. And a couple of things they're going to look at is how old the reserve study is, and then speak to the board and make sure that they are in agreement with it. Again, as an example of a phased replacement of roofs, or maybe street slurring is going to cost, $300,000. But then after talking to the board or the manager, they say, no, we have an extra couple of years on that because of the weather conditions didn't wear out our streets as fast. So the reserve study is what we start with. But again, we want to talk to the people on the ground, if you will. I get this, when is it time to enlist the help of an investment advisor? I have associations with $300,000 or $400,000 in reserve, and I have several with more than $10 million in reserves. Obviously, the more money you have, the more important it is to work with somebody. If an association has $50,000 in reserves, you can have all those funds in one bank. Perhaps at that bank buy 4 different $10,000 CDs and just do your own ladder, 3, 6, 9, 12 months, or 6, 12, 18, 24. It can be all in one account. But because of the FDIC limit of about $250,000, if an association has more than, say, $500,000, that's when you're looking at 3 different banks, and that's 3 different bank cards with your personal information on it as a board member. That's 3 different statements going to your managing agent. And that's just extra reconciliation and for the monthly statements, and then trying to coordinate what CD is maturing at what bank, who's going to roll over, who's on the signature card. So working with a professional, he or she can provide you in one insured account all of the CDs from different financial institutions, and then a recommendation that shows you, when we send out recommendations the month prior to a CD maturing, and it tells the board how much money they have in the money market, and it shows them a little chart of when the CDs are maturing over the next couple of years, and then we address those CDs that are next to mature and what we recommend doing with them. And that gives the board, in just a couple of minutes at their monthly board meeting, an idea of how their money is spread out, and what the recommendation is, and whether it makes sense or not. So to answer that question, I'd say anything less than $250,000, you can do it on your own at one bank. Anything over that amount, especially the more you have, and the more important it is to work with a professional.
And how does that person then get paid or compensated?
There's 2 ways they can get paid. One is a no-no. If you talk to anyone and they want to charge an annual fee or commissions, there's not enough money out there being made. CDs are only 3% right now. It doesn't make sense to pay somebody 1% to manage your money and make you 3%. So the way we work it, and a lot of advisors, I have a custodial bank, Bank of New York Mellon. They're the largest custodial bank in the world, and they're the bank from which we receive the CDs. They have several hundred different banks that participate in that inventory. So when I look at a 12-month CD for a client, I might have 2 or 3 dozen CDs from which to choose for an association client. The banks that participate in that inventory pay Bank of New York Mellon an underwriting fee for the privilege of having their CDs made available on this national market. So then when I take a portion of the CD and the inventory and put it into the name and tax ID number of a client, I receive a portion of that underwriting fee. The clients shouldn't pay an annual account fee or any kind of commissions or any other fees like that.
That's pretty attractive. The bank says, thank you, Dave, for using our services and moving our money around, and the association doesn't have to bear the burden of that.
Correct, yeah.
Very nice. So bottom line is, sounds like when the things get big and complicated, when you cross that $250,000 line, and that's combined operating and reserves. So if you have 50 grand in operating and 200,000 in reserves, you are right at that line. Then all of a sudden you need to start thinking of multiple bank accounts. And we're even talking different institutions. We're not just talking different branches, right?
Exactly. If you have $200,000 at Goldman Sachs Bank, you don't want to put another $100,000 in a separate account at a separate bank branch of Goldman Sachs, because it goes by the FDIC certificate number of the financial institution and the association's tax ID number when it comes to the $250,000 FDIC limit. So for us, we'd have a client that might have 22 different CDs, all from different institutions, all less than the $250,000 limit. If you have money in your bank operating account, then you have to consider that towards the $250,000 FDIC limit if you also have reserves in that same bank.
So fortunately, the more complicated it gets, the better reason it is to enlist the help of an expert. And it sounds like you just plain have a different gear than the average board treasurer, or would I say the accountant at a management company. You have an entirely different gear than they have.
Yeah, I mean, it's what we do, for 32 years with hundreds of different associations. So this is, we're the expert in this. Just as when it's time to go out and get your fence painted, sure, the treasurer and the secretary can go buy the paint and the brushes and go out and do it themselves, but you're probably far better off and have better results by hiring somebody that does nothing other than painting fences. They have the equipment, the expertise, the time. This isn't really something that I think you should go, the do-it-yourself route when you're talking with other people's money.
Right. And that illustrates the third point of the business judgment rule. When it gets complicated and when you don't know, get the help of a professional.
Yes.
Yeah. And in most cases, even doing this, which is in the best interest of the association, it's going to cost the association nothing. So that's absolutely wonderful.
At Association Reserves, we make the present less stressful and the future more secure. If you want to join us in this mission, please like this video and subscribe to our channel. Leave a comment down below on what you'd like to see us address in a future video. Let's plan for your best future.